I'm going to leave it. All right, move on. We're rounding up liquidity. So we're going to ways to improve liquidity. Liquidity problem, it's a problem that we have to eradicate as a business if we really want to continue to be in existence. Because without liquid, the business will not be able to survive. So whatever you can do as a business, ensure that your liquid is intact. That means you have cash. So what are those measures you have to take to improve your liquidity? Number one, sales of assets or leaseback. The first thing you could do as a business to improve your liquidity is to sell those assets that you're not using anymore. They are considered to be not useful. So why do you keep them when they're not, when it's not being used in the organization? So sell them to get cash. That's sales of assets. Do we understand sales of assets here? You don't sell the assets you are using. You sell those ones that are considered to be surplus to requirements. Do we get that, please? Do we get it or not?
Yes.
Great. Do we get it or not, please?
Yes.
Okay. Then we have leaseback. For leaseback, it means you have the facility, you are selling it to get cash, and you find an agreement to get it back on lease. So when you are able to do a leaseback agreement, it simply means you've sold the asset, it doesn't belong to you anymore, stop writing already. You sold the asset, it doesn't belong to you anymore, you become a leasee. That means you are getting that asset from the owner for it to be used for a specific period of time. That's what leaseback is. A leaseback agreement means you have a facility like this building, I need cash, I can sell it out. As soon as I sell it, I get it back as a lease. So to use for a specific period of time before I can find my new facility. Do you get it? So you have cash with you and still have possession of your assets. Is it clear? So that's one way to hold on to still have liquidity with your in your business. The second one is supplier credit terms. This means you are able to delay your credit supplier's payment. You bought on credit, you are supposed to pay at a specific period of time. Delaying the payment means you have cash with you. So that would allow you to have, because there will be less cash outflow when you delay the payment of your credit suppliers. But the problem about delaying delaying the payment of credit suppliers is that they might withdraw their credit facility or they deny you of a subsequent credit supply. Do you get the problem here? When you delay the payment of your credit suppliers, they might not trust you anymore. As a result, they won't be able to sell on credit to you subsequently. Do we understand that? The third one, factoring. For debt factoring, simply means as a credit customer, I present my invoice to a debt factor, which is an agent, like a bank or any financial institution or specialist organization. They buy the invoice at a certain percentage which is agreed by the credit supplier. So this is how it works. If the invoice is having, let's say I'm owing my credit customer or credit supplier $1,000, which I cannot pay back, I will propose it to a debt factor, which is a middleman. So what he does, or what the organization will do is, the 1,000, it will discuss with my credit supplier the amount it wants to pay on the invoice. So the value of the invoice is 1,000. The debt factor might say it wants to pay $900. So it depends, it's now on to the supplier, the credit supplier, to accept or to reject. But when you know that the debt is going bad and you are not expected to get the cash from the credit customer, so if a debt factor is able to negotiate with you to pay $900 promptly, you would want to give it instead of waiting forever, and you don't even know if the customer is going to pay back. Do you get how debt factor works here? It's an agreement to reduce the percentage on the invoice so that the credit customer or the credit supplier will be able to get that cash as soon as possible. Is it clear or not? Do you understand debt factoring here? You can do it, it's a business. So I buy the invoice, I buy your invoice, and I buy the invoice from you and pay back to the credit supplier at a reduced amount of money to make a profit. So as soon as the debt factor pays, the 1,000 will be received from the credit customer. So I'm going to pay on your behalf, and I will come back to get my money from you. Do you understand how debt factoring works here? So as doing this allows the credit customer to have enough cash with it. Is it clear? Is it clear, please?
Yes.
And the last one is inventory JIT, inventory just in time. By doing this, it simply means you only buy components or raw materials as soon as you need them for production. So you don't keep components or raw materials until they are needed for production. Okay. So by so doing, it means you won't be holding on or stocks that are not good, expected to be sold at a point in time. Just in time means I will only call or make order for components or raw materials when I have to use them for production. Do we understand just in time there? So these are methods which a business can use to increase or to improve its liquidity. Any question about liquidity improvement? Good. So that takes us to working capital. For working capital, it simply means the amount of money a business needs when it comes to day-to-day running of the business. The amount of money needed to run the day-to-day running, or to run the day-to-day activities of the business. So it is also called the circulating capital. So a business needs a working capital to cover its expenditure. So you cannot cover your expenditure. You cannot pay for your expenses without a working capital. Any question about that? Good. So the formula for a working capital is current assets minus current liabilities. And when we talk about current assets, these are assets that are expected to be used up within a year. For current liabilities, these are debts that are expected to be paid off within a year. Any question about that?
No.
Great. So how do we manage the working capital? Managing the working capital depends on, one, how big or small the business is. A very big business would need a large amount of working capital. The inventory levels. How much more do you keep inventories? A business that keeps large inventories would need large amount of money in terms of working capital. And the third one, debtors and creditors. If a credit supplier does a lot of credit, it will mean that it's not going to have enough working capital. The working capital will be negative because you do a lot of credit. You're supposed to be here, not there. You do a lot of credit. When you do a lot of credit, it reduces the amount of money available to you. So that means you'll be running on a negative working capital. And for debtors, if debtors are able to, as a business, if you are able to buy more on credit, it allows you to have enough money with you, which means you're going to have enough working capital. Note, for a business to run smoothly, it needs twice as much as the current asset compared to the current liability. So for a business to be solid and to be run smoothly, it means your current assets must be twice of this. What time is it when I'm talking here? For your current assets, for you to run your business smoothly, for you to have enough working capital, it simply means your current assets must be twice as your current liability. That's why the current ratio, what we did yesterday, is for a current ratio to be ideal, it has to be 1.5:1 and 2:1. Anything more than this means that the business is running on a negative working capital. Do we understand? So the bone of contention about working capital, or what you need to understand about working capital, is that you should ensure as a business that your current asset is doubled compared to your current liability. Are they clear? Thank you.